The Securities and Exchange Commission. The primary federal legislation regulating the securities markets in the United States is the Securities Act of 1933, which mandates that companies selling stocks or bonds to the public must disclose detailed information about their offerings, including financial health, assets, and executives, to protect investors from misleading marketing practices. This was the first federal law to regulate the securities industry. A few more key points about securities market regulation. The SEC is the federal agency responsible for enforcing securities laws and regulations established by the Securities Exchange Act of 1934. The main goal of securities market regulation is to protect investors by ensuring transparency and preventing fraudulent activity in the market. The key aspects of the Securities Act of 1933 required companies to register their securities before selling them to the public, and mandates detailed disclosure of information about the offering, including company financials and management details. Key aspects of the Securities Exchange Act of 1934 established the SEC as the regulatory body for securities markets, regulates secondary market transactions, including stock exchange operations, and prohibits insider trading and other fraudulent practices. The government regulates securities through laws and agencies, including the Securities Act of 1933, the first federal law to regulate the stock market, requiring companies to disclose information about their assets, financial health, and executives, the Securities and Exchange Commission, or SEC, the government agency responsible for regulating securities markets and protecting investors. The SEC was established by the Securities Exchange Act of 1934 in response to the stock market crash of 1929. Base 3, an international accord that sets standards for liquidity, leverage, and reserve capital to enhance the stability of the international banking system. Truth in Lending, a federal law that requires lenders to clearly disclose the terms and cost of a loan to consumers. SEC Form 13F, a quarterly disclosure that requires institutional investors with more than $100 in assets under management to report their equity holdings. The SEC's mandate includes transparency and disclosure, ensuring that disclosures from those offering publicly traded securities are thorough, accurate, and timely. Investor protections, overseeing key players in securities industry to ensure fair and honest treatment of investors. Market integrity, detecting and preventing fraud and market manipulation. Capital formation, promoting the pooling of investment capital needed to grow American businesses. And lastly, enforcement, pursuing civil enforcement actions against those who violate securities laws.